Volatility brings opportunity. Hi, this is looking at the markets, and yeah, there's volatility, there's fear in the markets, and a lot of people will say buy when there's blood in the streets, buy low, sell high, but how many people actually do it? And what are you going to do? Are you going to feed into the fear, or are you going to embrace the fear, embrace the volatility, embrace the opportunity that's out there, at least as I see it? It's not very often that the CNN Fear and Greed Index goes into extreme fear territory. It's usually around here, or that's how it's been for most of 2023. Greed, or sometimes extreme greed, sometimes neutral, but rarely fear, and even more rarely extreme fear. So I'm glad to see it there, and I hope you are too. And not many people are. If you go onto social media, and I enjoy social media for entertainment purposes, or just sometimes to see, get a gauge of what the sentiment is among retail investors and traders. But if you follow their advice, you're going to end up selling at the worst possible time, and you're going to end up buying at the worst possible time, most likely. Now, I cannot tell you what to do or what not to do. It's your money. You're responsible for it. This is not investment advice at all, but I am leaning into the volatility. I look forward to blood in the streets moments in the stock market and the financial markets generally. So does Warren Buffett, Charlie Munger, Peter Lynch, and they've done pretty well for themselves. They follow those Benjamin Graham value investing contrarian types of principles, and I hope you do as well, or at least, well, actually, I hope you do what you want to do. It's up to you, but I hope you at least consider buying when others are selling, and then selling when this needle gets into greed or extreme greed territory. I'm not telling you to just do whatever the opposite of the CNN Fear and Greed Index tells you to do, but just think about why the stock market is down now. It's because of good news. Yeah, good news is bad news again, apparently. Job openings picking up in August. Job openings increased to 9.61 million available jobs in the United States in August, and hires rose slightly to $5.86 million. This is good news for the middle class, but of course Wall Street doesn't care about the middle class. Most people in the middle class don't invest, really. Maybe they do. Some people do indirectly if they have a 401k with their jobs, but they usually don't take control of their own financial future, unfortunately. I wish more people would. So job openings are up, and that's good news for the middle class, good news for hardworking American families. But Wall Street doesn't like it. Why? Because we live in a backwards world now, at least in the financial markets, where there's fear that the Federal Reserve won't like this because the Federal Reserve doesn't want people to have jobs so much. Would you believe it? They want inflation to come down, even if that means making it harder to get jobs and keep jobs. Go figure, right? Even though the Federal Reserve doesn't control everything about inflation. They don't control supply chain constraints. They don't control oil prices. These are major contributing factors to rising inflation or sticky inflation. They don't control everything. All they can do is basically take liquidity out of the banking system through quantitative tightening, and they can raise the federal funds rate, which has a tendency to increase all interest rates in the United States. And so now they want it to be harder to get jobs. They want to raise interest rates on your credit cards and your mortgage loans and your auto loans, your car loans. So in order to tamp down inflation, if they even can, the Federal Reserve wants to make the middle class, they want to make life more difficult, I would say. But that's what they're doing. So the market is afraid that the Federal Reserve will keep interest rates higher for longer. They're afraid the Federal Reserve and Jerome Powell, the Fed chairman, won't like this. And also adding to the fear, and you can see the major market indexes were down 1.5 or so. NASDAQ almost 2 full percentage points. Two Fed officials warned rates to remain high for some time. Yet we knew that already. The Federal Reserve at the FOMC meeting last month hinted strongly at higher for longer interest rate policy. This should not be a huge surprise to anybody, but the VIX, Volatility CBOE, Chicago Board Options Exchange, volatility index went up 12% or so, almost hitting 20 on the VIX, which doesn't happen very often, or hasn't happened very often in 2023 so far. And look, this is not news. This is not something new, but the market is very reactive. Investors can be like children sometimes, all right? They can be very overreactive. They can be scared. They can be like Chicken Little, the sky is falling kind of sentiment. And fear can lead to extreme fear very quickly because just stock traders in the short term are very immature. They don't think long term, and they tend to overreact. But that's where opportunity comes in. And by the way, if you listened to Fed officials as an investor, if you based your investing strategy on what Fed officials say, Fed officials change their minds often, and they're often, typically they're lagging indicators, and they're wrong a lot of the time. You remember inflation was supposed to be transitory. Remember that in 2022? Whatever happened to that? So, yeah, I would not recommend basing your investing or trading on what Fed officials are saying right now. They're very reactive in the short term. And just for some perspective, this is from Bar Chart. 93% of S&P 500 stocks are now trading below their 50-day moving average, which is one of the highest levels of the last 6 years. Now, some people, some reactive people would say, oh no, stocks are down. Most stocks are down. That's bad. It means they're going to keep going down. I like to buy low and sell a lot higher. I don't sell at low prices, or I try not to. So this has typically coincided with the S&P 500 forming a bottom and heading higher. So I view this as a positive thing, not a negative thing. That's just me. You know, you have to form your own strategy, make your own decisions. And so what I'm doing is I'm screening, and this is from finviz.com. I'm screening for relatively low PE ratio stocks that are trading near their 52-week low. And I see some ones that I like right now. Doesn't mean you have to buy them, but I'm looking at them. Dollar General. You can see a kind of a miniature version of the chart there, daily candlestick chart, way down. I ask myself, is Dollar General going bankrupt? Are they going out of business? Is the stock going to go to zero? I doubt it. Anything could happen in the financial markets, but I doubt it. All right. NextEra, NEE has just been battered and beaten down, excessively so, I think. Some analyst downgraded it and gave it a really low price target of, I think, 33. I don't think it's going to 33. Just because it's down doesn't mean it's going to keep going down. And 33 would be obscenely low. It could. Anything's possible. Schwab stock, way down, just getting punished. Why Schwab? Schwab survived the regional banking crisis. Remember how the regional banking sector was supposed to implode? Yeah, we lost a few banks, 3 or 4 of them, some of the ones that were taking huge risks. But the regional banking sector didn't implode. It's still here. And Schwab, which is not necessarily regional, but, should it be trading at $51? That's something for you to think about. Target, way down. I think it's overdone myself. PayPal, way down there. And these are all stocks that are profitable. They have PE ratios. and low PE ratios. And so you can use whatever screener you like, or just look around for opportunities in the markets. That's what I'm doing. Okay, I'm leaning into the extreme fear. I like it. Now, I don't want you to get mad at me if the stock market keeps going down. It can. Of course it can. And that's why, I'm not buying large amounts of things at first. I'm doing what's called scaling in to positions. If you like a stock, if you think it's way too far down compared to where it should be, if you want, what you can do is just buy a little bit or sell one put option if you can afford to buy 100 shares, with plans to sell more put options if you can afford it, or buy more shares if you want to. If the stock goes down another 10%, another 15, another 20%, the idea is not necessarily to buy a stock and then buy more if it goes down 1% more or 2%. I hope you're waiting until it goes down a lot more before scaling in more. Anyway, that's what I'm doing. So I hope this is inspiring to some people. Hope it gets you in the mood to be a buyer rather than a seller. Again, you're making your own decisions here. Don't do what I say. Do what your research tells you to do. Do what the facts and the data tell you to do. And hopefully we can all profit together. All right, so I'll try to provide more updates, and I want to thank you for watching and listening. I will talk to you again very soon.